In today's show, I will be revealing the biggest whale secrets that crypto insiders and whales aren't telling you. I did a lot of research today. I basically spent all day looking into the reasons why whales don't disclose certain facts. And I want to reveal some of those facts to you guys and be very transparent about the truth of the industry and how you can utilize the whales tactics to your advantage to make money in crypto. It's going to be a big show. Let's get straight into it. So here's the brutal, honest truth. Crypto is not a fair playing field. The truth is that 99% of retail investors are at the behest of the top whales and VCs in crypto. The fact that it isn't a fair playing field, though, does give you an advantage if you know the secrets that these whales don't want to tell you. And if you know exactly what the top VCs and the top insiders are doing, then that gives you a massive leg up on the rest of the retail market. So there's certain things that we can be implementing into our strategies to increase our chances of success in crypto. I just published a thread on my Twitter, which goes in depth on this topic. And right now, I want to run through the 5 secrets that the whales aren't telling you that you have to take note of if you want to succeed in this market. Let's get straight into it. The first is the harsh reality that most DeFi protocols don't need a token. I'm a proponent that the world is moving to a tokenized model. So I believe that in the future, many real life companies would benefit from having a token model. There's 2 major benefits that companies have from going to a tokenized model. It enables the division of governance, which means that they can spread out governance rights, kind of like a DAO, to multiple token holders via utilizing tokens. And the other thing it does is it increases the liquidity of the company. So a company could be divided up in terms of its rights holders into multiple token holders. This therefore facilitates a secondary market. Now, I think that in the future, many companies, think big companies like Nike, Apple, Adidas, they're going to move to tokenized models for parts of their business because of the benefits that I just mentioned. But the reality is in crypto, some DeFi protocols, in fact, not just some, a lot of protocols have tokens when they don't necessarily need to have one, or the token is actually an afterthought to the product. So I want to break down what I mean by this and how you can avoid it to take advantage of it. In crypto, tokens are often created with the intent of lining teams' pockets as opposed to offering a strategic benefit. So oftentimes, someone will come up with an amazing product and then they'll think, how can I implement a token so that I can make money off this product? Like, I have a great product, now I want to monetize it through a token. The issue with this is that the token isn't at the forefront of the protocol design. If the token was the first thought, how can I make an amazing token? What product would I need to create in order to make this token successful? That would be a lot better for holders. But the problem is that a lot of tokens are created with the intent of lining the team's pockets. And a lot of projects in this market are cash grabs. There are thousands of projects in crypto now. And honestly, a large percentage of them are cash grabs. And it's something you want to avoid. So what are the ways you can avoid getting involved with cash grabs? So tokens that don't necessarily need to be existing. Well, the first thing you have to look for is if the token has a strong value accrual mechanism. Now, what I mean by value accrual mechanism is it's the ability of the token to increase in price based on its fundamentals. So can it capture the user growth, the metric growth in terms of its price? So something like a Luna does this really well. It has its UST burn mechanism. So every time a UST is minted, the equivalent dollar value of Luna is burnt. Frax also does a similar thing, and it does this very well. There are multiple tokens that also do this well, even Ethereum. If you guys know, the ETH token is the gas token of the Ethereum network. So every time a transaction takes place on Ethereum needs to be burnt. So Ethereum actually captures value through this burn mechanism. But the thing is, there's a lot of tokens out there in DeFi which don't actually capture value. The tokens exist maybe to give you governance voting rights over a protocol, but the voting rights may not mean much in the way of a lot of these projects. So that's the first thing you have to make sure you tick off. Does a project have token value accrual? The second thing is, does it fill a market need? So does this token actually complement another DeFi ecosystem? Does this token fill a real life need? Is it going to revolutionize industries? Or even if it's just crypto specific, what does this project do in the scheme of the ecosystem that it's built in? So if it's a DEX, What's it facilitating? What's the differences between this DEX and another DEX in the same ecosystem? If it's an NFT project, what utility does it have? What's it actually offering to players and to users that separates itself from the pack? So make sure you're not investing in tokens that are simply created for the sake of lining the team's bags. Invest in tokens that have a real market need and a competitive advantage over other tokens in the space. That is the other major thing to do with point one. Point two. Now, this is the biggest secret that whales don't want you to know. And it's a big secret that I don't know isn't why it isn't talked about more often, because it dictates so much of what actually goes on in crypto. And this is the fact that the majority of VCs make their money through investing early in token seed and private sale rounds. The majority of investors, at least in terms of VCs, are getting in at extremely low levels because they're taking advantage of the seed and the private sale rounds of a specific token. So you may think a project on the open market's cheap, but the reality is that the VCs got in at much lower levels. The majority of VCs actually got in at much earlier points to even when the tokens were listed on the market. So we see situations like this. Solana, for example, the initial private round investors got into it at 4 cents. That's a 2250x versus current levels. That's a massive return, guys. 4 cents to $90 is crazy. They also bought Phantom for 4 cents, AVAX for 50 cents, BNB for 15 cents. So you have to remember with this market that the VCs and the teams behind these projects got in at such low levels that even if the projects crash on the market, let's say BNB goes from $1,000 and crashes all the way down to $250, the reality is that the majority of these VCs got in so early. They got in at 4 cents. They got in at 15 cents. So even though the tokens crashed, they're still up a 200 to 2,000x on their investment, which means they're much more likely to sell than a normal bag holder. So you have to be very, very wary of this. So how do you actually check when the VCs got in? I believe this is a very important part of investing, and this should be something you always tick off in your investment process. Well, I discovered a website today called ICOHigh, and you can actually search in a project. So let's search in Phantom, for example. And if you search a project in, it's actually not loading because I got to search Phantom. I got to spell it out properly. If you search it and then you click on the project, it will tell you exactly what the ICO price was. So it tells us here that Phantom, the token sale for Phantom initially was at 4 cents. And then it shows us that 40% of the entire token supply was actually sold at 4 cents. So this gives us a greater indicator as to whether the VCs got in at certain levels. We can do this for any project. We can do this for Solana. We can do this for Avalanche, and you can go in and you can see exactly how much the VCs paid for the tokens. So the Solana first round was at 22 cents. The private sale, which was the round before, was 4 cents. So these investors are holding on since 4 cents. So they got in extremely early. And that's how a lot of VCs and whales make money in crypto. So private and seed rounds are crucial. And I don't want to say that they're the devil, because they are actually very important. What they do is they give projects initial funding and support to get off the ground. This initial capital is so necessary for a project to be able to build. And these strategic partnerships that they strike through these seed investments help these projects grow. The rounds aren't the problem. The fact that we have seed rounds isn't a problem at all. The problem is that retail forgets where the majority of VCs actually bought in. This creates large sell events. And this is the main problem in crypto in terms of these seed rounds, that the retail is just not aware, or for some reason people just don't realize that such a large amount of the initial holders got in at such low levels. And what happens is these massive sell events happen, and the token prices can take huge hits as unlocks occur. This leads to profit taking, or as some people would call it, dumping on retail. So I want to give you a little bit of a look into what the release schedule would look like in a project, so you can work out whether a project is a good investment or not. I use Moonbeam as an example because the Moonbeam token, it's a great token. I have a great belief that it fills a lovely market need as the main EVM-compatible L1 under Polkadot, and it won the second parachain auction. But the problem with Moonbeam is that it took a big hit because it had these unlocks due to the vesting schedule, which meant that large amount of tokens were unlocked at the market at certain periods of time. And we saw a lot of retail FOMOing in at the very beginning here when the token was $8, $9, $10, $11. And then it obviously crashed after one unlock, after another unlock, and now it's all the way down at $2.45. despite being a great project. So what you can do to actually work out how, if you're going to get exploited by these unlocks, or if you're actually getting in at a good time, is simply to go into a project's white paper. Now, for the example of Moonbeam, you can actually see exactly where the tokens are being allocated. You can see that 14% is the seed funding. You can see that 12% is the strategic funding. We can see that 10% was a community event, and 15% went to the crowd loans. But if you scroll down a little bit and click on the release schedule, this is the most important part, you're actually seeing when these tokens are being unlocked. And we can see that there's these cliffs. There's these periods where the tokens have a very steep unlock, and that could potentially impact the price. So we saw when it first launched, as we saw here, the token almost immediately crashed. And that's because from day one when it launched, the initial emissions went up by 15% in the first month and a half. And then we saw another cliff at around month 9 as well, which had another big spike. So this is the reason why a lot of projects, even though they're great projects, they may dump, because the tokenomics are favoring the VCs. The ones that got in for pennies on the dollar, for cents, are the ones that are selling after these unlocks. Now, I'm not saying everyone sells. I'm just saying potentially they have the capability to sell, and they're incentivized to do so, guys, because a lot of these VCs, they got in at 1 or 2 cents. Like, obviously, if they do 1,000x or a 200x, they're going to want to take a little bit of profits. So even though the project might be new to you and new to the market, it doesn't mean that it's new to these VCs, and that's something you have to be aware of as well. Watch out for the unlock dates, as I just mentioned to you, because that is a major, major thing. All right, number 3, and this is the scariest part, actually. I think this is kind of not talked about enough in crypto, and this is the fact that many projects don't actually have a product. Now, projects use seed and private rounds to bootstrap funding for development. So as I said before, if you're a new project and you want to build, let's say, a crypto game, you're going to need millions of dollars worth of funding to actually hire the developers necessary, hire the marketing team necessary to make it a successful project. And this costs a lot of money. But what this means is that you actually need to raise capital before you build a product. Now, in order to raise capital, you're going to need to have a white paper. You're going to need a roadmap. You're probably going to need a social media presence and some marketing. So this means that projects are actually doing their initial raises oftentimes before they even have a product. Now, this isn't the case for all products by any means, but many projects in crypto, and I know this because I've been speaking to a lot of projects, many of them don't have a product when they're first doing their initial raise. And this is an issue because I put out a fancy white paper and ambitious roadmap, and then the product they actually deliver is nothing resembling what they initially promised. Now, we've seen this flood the NFT industry. How many NFT rugs have you seen over the last year or two where their roadmap looks fantastic, everyone's convinced it'll be a success, and then the actual product looks like a dump because they've overpromised, they maybe didn't have the funding, and they've underdelivered. So this is a major problem in crypto. And this is just the way crypto works, which is fine because obviously these projects need funding to develop. So I'm not disputing that fact. But what I'm disputing is it becomes a problem because when the market slaps an exorbitant price tag, so a very expensive valuation on a project before it even has a product, this creates expectations. This creates the expectation that the project will live up to its hype and live up to its potential hype cycle, which can become an issue because it significantly increases the risk profile of said investment. We can see across many gaming projects. Now, this isn't hating on gaming, but gaming is one of the newer industries in crypto, so it needs more time to develop, which I understand. But a lot of gaming projects, they have 100, 200, $300 million valuations, maybe even $1 billion plus valuations, and they don't have much of a product. They maybe only have a team of 10 to 20 people, yet they're commanding a $500 million valuation. Now, if we compare this to the traditional stock market, if you have a valuation of 500 million in shares, that's massive. That's a quantum valuation. That's a valuation that very, very successful companies and businesses with hundreds of employees have. In crypto, it isn't as hard to command a $500 million valuation as it is in traditional markets. And this is a problem because the market prices in success before these tokens even launch products, which can be a bit of an issue. So basically, you have to ask yourself 3 questions. This is how you avoid it. Ask yourself, does the team have a proven track record? So have they released successful projects in the past? And do they have a history in this industry? Maybe if they're a gaming project, you can look at previous games in traditional gaming that they've made. If you're looking at a DeFi project, look at if the team was involved in successful traditional finance projects. Who are the big backers? Look at who is actually funding these projects. Money isn't dumb. You want to follow the smart money in crypto. So if you have big backers like Alameda Research, Delphi, Jump Capital backing projects, then that is going to be a much better position for you as an investor, knowing that you have the security of these big backers than if you're investing on a whim. Now, the one caveat I will have with these big backers is that sometimes they'll chuck money at anything that sticks, because there's a lot of money, there's a lot of VC money going around in crypto. Just because a big backer backed a project doesn't mean it's good. They may have just put in like a small amount of capital as a risky bet. But what I will say is that it does give me a vote of confidence that that project is solid, at least compared to its competitors. Number 4. This is secret number 4 that the whales don't want to tell you. And this is actually one of the biggest secrets and one of the biggest issues in DeFi as well. So I want to get into it. But just quickly before I get into that, I wanted to say that if you sign up for a ByBit link in the description to trade using a ByBit account, you are eligible to have your portfolio doubled. So I'm literally over the next couple of weeks going to be doubling your portfolio on the show. So if you don't have a ByBit account and you want to sign up and deposit some money, use the link in the description and you could have your portfolio doubled on the show. So, I mean, it's free money basically. So go sign up for a ByBit account and enjoy trading. It's a very good platform and they're one of the official show sponsors of the show. But back to point number 4. APRs are meant to incentivize liquidity. So in the real world, what will happen is companies will first launch and they'll offer certain incentives. So let's say you're a software company. You might offer a discount on your subscriptions for the first, let's say, 2 months of launch in order to incentivize users to come in and use your product. Let's say you are a new grocery store or a new food market. You might have certain discounts, like a buy one, get one free deal for new customers because you're just launching. Or you might launch with cheaper products on your shelves than your competitors because you want to get new people through the door. That is how it works in real life. In crypto, it works basically the same. But instead of being a company offering a first-time sign-up bonus or a discount on a product, they're incentivizing using their APR. So what they'll do is they'll boost the yield on their pools to show a very high return, which incentivizes new participants to come in and stake in those pools because they're earning a crazy yield. So instead of incentivizing via discounts like in traditional finance, crypto incentivizes via emissions. This creates opportunities and both a massive, massive mistake that a lot of investors make. Now, this model, this incentivization model in crypto has worked really well for Luna. Obviously, Anchor Protocol, over the long term, it can't sustain a 20%. We saw the yield reserve was draining slowly over time. But what they did do is they attracted so many users. Anchor attracted over $16 billion worth of liquidity. That attracted users that wouldn't previously be exposed to the Terra ecosystem that now are, that have Terra Station wallets now, that are actively participating in other dApps because Anchor brought them in. So that was all part of the Terra Foundation's plan to bootstrap, so take a little bit of a loss on their Anchor Protocol incentives at first, but to bootstrap liquidity and get people into the ecosystem. We saw this work for Curve Finance as well. We've seen this work across multiple protocols. But for the majority of DeFi projects, and obviously Anchor and Curve are shining examples, the majority of DeFi projects actually fail in this aspect. And that's why you've probably been wrecked on some of your positions. I know I have as well. And the major reason behind that is because emissions end up being a project's biggest downfall. So I've got a few examples here of when it was a downfall. Sunny. The problem with Sunny was that they did a huge emissions incentive, a huge liquidity incentive within the first couple weeks of launching. And then they just dumped tokens onto the market. The token price plummeted. They didn't have utility to keep underpinning the token, so they couldn't sustain buy pressure, and their emissions kept inflating. So what happened was the token eventually crashed. We saw it with Time Wonderland as well. They had this crazy dilution on the rebasing. So even though it was a 100,000% APR, the problem is that the token over time just went lower and lower and lower and eventually crashed to be essentially worthless. Obviously, a lot of Danny FUD had something to do with this, but the token, even before the Daniela scandal, I guess you could call it, was still decreasing heavily because of this insane dilution. So we see it time and time again in crypto. Pegaxi is another example of this. We see events where dilution can't actually outweigh the buy pressure for a token. And this is a major issue. So the way to avoid this is to look at protocols which are generating fees and have a high fee generation ratio versus emissions. One of the biggest questions in crypto right now is what will happen when emissions run out? As you guys know, a lot of protocols bootstrap initial liquidity with a high emission, and then eventually those emissions run out. So what happens in 2 to 3 years when some of our favorite protocols right now, emissions start to decline as per their tokenomics schedules? Well, we get a situation where potentially a lot of people could exit those positions. So how do we get into the projects that we know that won't happen for? Well, the projects that incentivize fees, the projects that are actually generating revenue via fees are the ones that are going to come out ahead of the ones that are generating revenue via emissions. It's basically, fake revenue at that point. So that's the first thing you have to look at. Who is generating the highest fees versus emissions? Who has tangible users and trade volume? Who actually has users swapping? Look at trading volume on DEXs. Look at the amount of user growth, wallet growth with L1. See if the protocols are actually being used. Look at if they have strong token value accrual mechanisms. As I mentioned before, can the token price actually reflect that user growth? And look if there's real utility. That way, you won't end up holding the bag on a farming token which endlessly prints. You'll be holding the bag on a token which is actually serving a purpose, generating fees, and has a real utility behind it. Now, the number one rule here is never to chase yield. Don't buy a token solely because it's paying a high APR. Invest in a token because you have conviction in it, and then farm it as a secondary. Don't pick the tokens you want to invest in based on the APR and then hold them as a secondary. This mindset shift is something that can actually unlock incredible profits for you in this market, because as soon as you start prioritizing protocols with utility that you have conviction in over the yield you can earn on them, that's the moment where you start becoming a lot more profitable, because you stop falling for these APRs that are just incentivizing liquidity and you're not chasing yield. You're actually investing based on fundamentals. And you'll often find that the projects with the best fundamentals still have amazing yield opportunities, which, obviously I do as a DeFi-centric show here on Crypto Banter. That's the kind of stuff I want to show you, how to earn yield on your token. So if you're holding Solana or AVAX or Phantom, cool, you're holding it in a wallet, but how can you actually maximize the yield on those tokens? Now, just quickly, if you want to buy any of these tokens that I've spoken about, 1inch is one of the best places to do that. So you've got ByBit as your centralized exchange, and you've also got 1inch if you have money on a DEX. They offer some of the cheapest and fastest swap rates, and they're another one of the official show sponsors here. I think we've got 2 great sponsors for you guys, and I think, 1inch is an amazing protocol as well. But don't buy a token solely because it's paying a high APR. That's one of the stupidest things you can do in crypto. Now, I've got one last point, and I saved my best point until last. I've got a compelling graph that I want to show you, which is suggesting something very, very interesting in terms of whale accumulation. And this point, and kind of a secret, that's not really a secret because we know about it, but we often forget about it, is that the whales do the opposite of the market. As Warren Buffett famously stated, I'm sure you've heard this quote before, be fearful when others are greedy, and be greedy when others are fearful. You basically want to do the opposite of what your emotions are telling you in this market. Now, historically, in traditional markets and in crypto, the ones that came out the furthest ahead were the ones who bought the fear and took profits during the greed periods. This is the way that people throughout history have profited for hundreds of years in traditional markets. So why would it be any different in crypto? Whale accumulation, and this graph is honestly mind-blowing. Whales accumulate when the market's low, and they take profits when the market's high. So let's actually have a look at the Bitcoin whales holdings from Glassnode, which Will Clemente tweeted. And we can see a very interesting pattern. You guys probably remember last May when the tokens were pumping in May 2021, everyone was FOMOing in. A lot of people were buying in during that time. Well, this green line here is the whale accumulation. So how much the whales are actually holding. Their holdings decreased over this period when the market was pumping. In fact, as the market started pumping, their holdings started tanking. This means that they were taking heavy profits in May. Let's skip a little bit to September. This is when the Bitcoin price crashed. I don't know if you guys remember July, August. It was a terrible month last year. The Bitcoin price took a massive hit. What happened when the price took a hit? Well, the whales started accumulating during September. Now, when the market started pumping in November, everyone was euphoric. Token prices were hitting an all-time high. Let's look at what the whales were doing. You guessed it. As the token price started pumping, we can see the Bitcoin price is this gray line here. The green line, which is the whales, they started selling. So they were taking profits in November. So what are they doing right now? We can see that they do the opposite of the market, which obviously happens for a reason because the whales are smart. They know that they want to buy the blood. They know that they want to sell into the greed. Let's see what's happening now. Bitcoin price is dropping. Whales are accumulating. Whales are actually accumulating right now. Now, on-chain metrics, of course, there's many caveats to them. So it's not the only factor in terms of predicting this market, of course, but it does give us an indicator into what the smart money is doing. They're actually accumulating right now despite Bitcoin going down in price. Now, take that with a grain of salt, but at the same time, it is interesting to note that every time, basically, they've got it right. And that's just data that is public information on Glassnode that any of you can look at. So my way to summarize that strategy is very simple, and without overcomplicating it, I do have previous videos where I talk about my in-depth profit-taking strategy. But if you want the TLDR on this market, the easiest two things you ever have to remember in crypto is take profits into the massive pumps, aka the greed, and buy into the massive dumps, aka the fear. Rinse, repeat. And if you do that, you're officially a whale, because that is what the whales are doing in this market. I hope you guys enjoyed this video. In fact, smash the like button if you did, because I just revealed 5 secrets that most crypto influencers won't tell you, but I think it's too important for you guys not to know these things. And I believe transparency is key in crypto. So smash the like button if you enjoyed those five secrets that not many people are talking about. And I'm going to do another video in the future and give my other 5, because I believe these videos are some of the most important things in crypto that you guys need to know about. Make sure you smash the like, subscribe if you are new to the channel. I will see you in the next video. Peace